Good afternoon, everybody, and welcome back to Markets for Millennials for our weekly market wrap from this short week here on May the 31st through June the 3rd. Only a 4-day trading week due to Memorial Day, at least here in the United States. Obviously, futures and FOREX were open for parts of Sunday evening and Monday morning. But in general, we're covering a short week, and we've been here on the in the midst of a bounce, and in my opinion, this is nothing more than just a bounce, and I'll explain why in just a little bit. What I wanted to do, if you looked at the thumbnail for this video, you saw the picture of Elon Musk, and just this morning, Friday morning, Elon was making headlines because he talked about being nervous about the markets, and this is a lot of people acting very surprised, a lot of people acting like this is something sudden and now we have to pay attention. But if you've really been paying attention, there has been a lot of forward guidance given by a lot of really large corporations that have suggested a slowdown, and they're basically preparing us for disappointing earnings over the next quarter or two and possibly further into the future, in the midst of the Fed tightening, and in the midst of just kind of the economic slowdown, inflation being high, and though they continue to say that the economy is strong, it remains to be seen if that's actually the case. And so there's just a lot to really digest, and a lot of people have been looking for the market bottom. And I kind of look at what's going on in the markets these days in the same way as everybody always looking for a top. And I think, one of the things that stuck out to me, if you go back over the course of the run, just from the March 2020 lows up to where we peaked out, just in this stretch right here on the S&P 500, if you're looking, you can see on the left, that's the bottom of the March low, and then up here is on the right side is where we peaked out. And it was funny because all throughout, you have the macro bros, as we would say, right around this period of time, calling for insolvency events, saying we're going to go retest the lows and we're going to make lower lows and all that. And then it didn't happen. And then we had a similar sort of thing happen here. Oh, finally, it's going to happen. And so it always seems to be the case that in the bull run on the way to the upside, that everybody's always looking for the top. 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 And in the same way, if we go back now to where we're at now, to the downside, everybody's looking for the bottom. Everybody's looking for the bottom. Everybody's looking for the bottom. And I just, that's one of those things. They say that in a bull market, the markets will climb a wall of worry. And I've been trying to think, well, what's the bear market version of that? Every bounce is a bounce of hope, and but it's also a bounce for all of the large institutions and big players and the smart money to sell into. And that's exactly what I see happening here in this particular juncture. Because honestly, in the big picture is a lot of people, we were talking about this previously in my last update. We're talking about how right here is right around where you started to hear from, apparently you were hearing from Fed speakers, that we might pause in September. People are already looking for the pivot. And so people are getting excited on these bounces. And the thing that a lot of people are saying it, but I've been saying also recently, is that bear markets don't bottom in the middle of excitement. Like, they don't bottom with optimism. They bottom with despair. And so just like everything else, just like how in the bull markets everyone's looking for the top, in this bear market everyone's looking for the bottom. And the best thing to do is to set yourself up with multiple edges so that you can wait for clarity. So obviously you do TA, obviously you pay attention to the macro. And so what I wanted to do is on this update, we'll look briefly at what's been happening in price action, but I want to also look at a couple of other things. So here we have the S&P. A lot of people were pointing out this level right here. as a support level because of this little high on May 17th. But I don't see it that way. I don't see this as, I mean, I didn't see this as like a really strong resistance zone. My resistance zone is actually a little bit higher, right around here. And if you actually pay attention, that's where we kind of hit into and wicked a few times. We even had a close above yesterday, but obviously a really big down day today. I'm not saying that we won't continue to bounce, because I mean, if we just kind of review back a little bit, on this bounce right here, our, from mid-March into, end of March bounce that we had last time, a lot of people were saying, and myself included, that it was actually an optimistic sign that we made a higher high than this. And a lot of people might have even been looking at, the low here or the low here and saying, oh, look, we got above it. We're going to celebrate. But in this case, I still see this as, being into resistance. There's still way more work to do to get back to being hopeful about the direction of the equity markets. So even though we did get aggressively bought right here in the middle of this month, which was right around a little bit of a support level, I suppose you could say, the bigger support on the S&P is down actually closer to between 3,500 and 3,600, and that I think is eventually where we are going to for sure get down on the S&P. And I could be wrong, and I'll pivot when the markets show me that. When I start to see the Fed actually pivoting, when I start to see a change in the macro picture, I will pivot. But for now, I mean, my base case is that the S&P is going to fall into that range, or very close to that range. I think that's very, very likely, just given the Fed is right now trying at all costs to stop inflation, and there's a lot of time between now and even between, if they did pause in September, even if that was a thought, there's a lot of time between now and September. There's a lot of time between now and the end of the year, and so. I mean, could we see? I mean, let me see if I can do a bars pattern really quick. I didn't plan on doing this, but could we see something like this? Look at that. I mean, could that happen? I mean, by all means. Like, if you think about it, it was 2.5 months ago that we were starting our bounce at the end, in the middle of March. I mean, so theoretically, you could see, 2.5 months, like, where does this put us at an end? This is, August 1st to August, 11th, where we're getting this bounce from. So, I mean, if you think it's impossible that we could get that low, I mean, think again. And obviously, if we were to get that low, I mean, I don't know why my chart is not showing up. Sorry about that. Hold on a second. Let me see if I can fix this here. I don't know what's going on. In any case, let me do that. That would be 25% down. So it wouldn't even be 30%. But you have to imagine that if the S&P were to fall like that, then the NASDAQ would have an even greater decline. You can actually see we're above, we're closing right at about that level that I think is, at least on the S&P, is the most likely support. But on the NASDAQ, I actually think that level is going to be right here. So that's going to be under 11,000 in my opinion. That will get to, and just the rate at which the NASDAQ is declining, it wouldn't surprise me if we got under 10,000. Actually, let's be honest. I mean, would anything surprise you anymore? I don't mean to say that I'm positioning for that to happen, but it could happen. The Dow is looking a little bit stronger than everything else, but still kind of same story. We're still underneath some significant support, some significant resistance. We just kind of have like a zone right here, which we obviously have now sold or been bought up into. I just don't see that being a place that we just break through super easily. Of course, I could be wrong, obviously. The Russell, really quickly, the Russell actually didn't make a new low. We talked about this. I don't need to go over that again. But again, the Russell has some significant overhead resistance at this red dotted line that's been there for a really long time. And I think it's only a matter of time before this thing rolls over as well. Although I do believe it will outperform outperform is maybe a strong word to say. I think that it's moved down because again, if you think about when we made the lowest low here on May 11th, you go to the Nasdaq, and on May 11th, we still made a bunch of lower lows on a closing basis. So I think you're going to see on the Russell more and more of this consolidate, fall, consolidate, and you're going to get this a lot where the Russell makes its low earlier, I think, than the other indices, and then consolidate sideways as the other indices continue to decline. So I was going to say, that the Russell would outperform. I mean, I have a very nuanced view of that, and I'll go over that in just a minute. But I just want to take a look at the dollar here because the dollar has broken out a bit from its consolidation, from its decline. And obviously, like I've been saying, just like my view on all the other markets, I'm not looking to pivot. I mean, I've been saying basically since like down here, or no, actually that's not true. I've been saying since right here, well, the trend is up, the trend is your friend, and we're going to just continue to go up. And I still don't see anything in the macro that suggests that we're going to fall a whole lot further. I mean, we're still trading above 100. So this kind of this area, I mean, like what do you think we're more likely to do? Get to 99.50 or make a higher high? I mean, we're right at kind of the 50-yard line between those ranges right now. And in my opinion, we're more likely to make a higher high than to go down to this level. And until the macro changes, I don't see any reason to have a different view. So I think that the pause in the dollar is over. And I also think the pause in yields is over. I mean, if you look here, you can actually look right there. That's a line to watch. We tested that as support, and we broke up through kind of this trend line, and we're back onto the upside, real close to 3 again. And the trend is up. I think that you can't have rises, and this is just like the dollar. You can't have rises that are this like strong without having a significant pullback as well. And so kind of like what you saw here in January 2021 into April of 2021, we had such a strong move to the upside. I mean, like, I'm not suggesting, my view on yields is a little bit different than on the dollar. I'm not suggesting that we're just going to, next week get back up above 3.2%, which was our most recent swing wick high. We could, but it would not at all surprise me to see a consolidation similar to this happen. So, I mean, if you want to take a bars pattern and do something like that, obviously it's not going to look exactly the same, but I could see it being something like this. That would bring us down to a little over 2.5 if we had that type of consolidation. I'm not putting my money on it, literally or figuratively, but it's totally possible that we could have some more consolidation. If we consolidated like that, then that might be good for an asset bounce. But I don't think that's likely. So what I wanted to show you is I wanted to go down to a few charts. This is a chart I've been tracking for a little bit, kind of behind the scenes. I usually don't make room in my analysis for it, as far as in these videos. But what I'm going to do is I'm going to turn on my SAMS indicator here. And what I want you to see here is that the SAMS is showing you that we are bearish. So what this is the S&P high beta. So those are highly volatile. Like they tend to, in a bull market, they're going to outperform everything else. And in a bear market, they're going to get destroyed much greater than everybody else or everything else, versus the S&P low volatility. And those are stocks that have betas that are much lower than the market average. And what this means is when this is bearish, colored red, then what that indicates is that there is a desire to be in much less volatile names. And what that gives you, what this indicates in general, is that you're in a situation where there's a little bit more fear in the markets. There is more of a run to safety, or to try to hide your money in defensive names and things like that. So that's why in the SPLV you'll find more defensive and consumer staple and like those kinds of companies. And so I like to look at this because it gives you a good idea of the appetite for risk, much in the same way that we look at the JNK, the junk bonds ETF, as kind of indicating the appetite for risk, as well as a bunch of other indicators too. But I just wanted you to see that the SPHB over the SPLV is trending bearish. So again, just to remind you, if you haven't heard me talk about my SAMS indicator, basically the idea is that it doesn't tell you exactly where price is going to go. I mean, no indicator will be totally predictive. What it just means though is if it's red or green, it's the statistical likelihood and the strength and momentum that is behind price and the way that it's moving. So in this case, red means that the statistical likelihood is that price is going to continue to fall over time, versus when you have green, it tends to suggest that price is going to trend to the upside. And so obviously I don't position based on when it changes, although it does indicate that it is much more of a high probability trade, because obviously I use this in conjunction with lots of other things. But that is one thing that I like to look at. So I just wanted to show that just for a brief moment. And then the other thing that I wanted to show you is the IWD over the IWF. And so this is the Russell. Let me do this on a 3-day chart. That way the candles look a little bit better. This is the IWD and IWF. Those are Russell 1000. This IWD is Russell 1000 value. IWF is Russell 1000 growth. And so this is a really good indicator again, because when there is greater appetite for risk, you tend to see more. You tend to see investors position more for growth than for deep value. And what this is showing you, we kind of made a double bottom here. So I'm anticipating this, coming up kind of more up this direction. And that's kind of why I said that thing about the Russell outperforming, which obviously I need to be careful and more nuanced with what I'm saying. But the general idea here that I get is that the value stocks are going to outperform here because people are going to be moving away from risk more and more, especially with the macro backdrop, and they're positioning themselves for deep value so that they can weather this storm, so to speak. And so that's also why I think you see the Dow, again, going back to the Dow chart, that's why you see the Dow outperforming versus the other indices, because the Dow has actually like a lot of industrials, a lot of defensive stocks and things like that. So that's definitely something to look at. So not only on the chart can you see that it's double bottoming and making a higher high, but then when you look at the SAMS indicator, it's clearly bullish in its price action. And so that's definitely something that I've been watching as well. I was just talking about the JNK. I want to just really briefly again kind of show you what's going on here. And what you see here is we've been moving to the downside. We've been in a clear downtrend. You can kind of see when you pull it back from the March low, and then we got this big crest, and we actually crested in September, which is kind of interesting. And that goes to a point that I've been starting to bring up a lot more lately. But I talked about this. We never made a higher high than our pre-COVID levels on the JNK. So I thought that was telling as I started to look at it. and our bounce brought us right up into this trend line perfectly, and we've been coming off ever since. So J and K is a really good indicator of the appetite for risk, and I think that it's really important. Just if you look at the tips, it's also on its way back down. Although today it had a really big up day, but I really think that you have to really pay attention to what bonds are doing, particularly U.S. Treasuries, because I've been talking about this a little bit. Maybe this chart's a little bit harder to see, but one of the things that I've noticed as of late is that the bonds have typically peaked and troughed, I guess, if you want to say. Its highs and its lows have tended to come just ahead of the S&P 500. So in the white line here on this chart is the SPY, which is the ETF that tracks the S&P 500, and then the orange line is the TIP ETF, which tracks Treasury bonds, U.S. Treasury bonds. And once again, what you see here is that ever since the top, all right, so we peaked in November 9th, which is, I believe, the same day that the NASDAQ and Bitcoin, maybe not the NASDAQ, that definitely Bitcoin and some of the higher beta, securities and stocks and assets topped. And then it was shortly after that that the S&P topped. It was about a month and a half after that the S&P topped and has started to fall down. And you actually see that when this line, what I think has been really helpful to notice is when the orange line crosses, then what I expect to see, if it crosses with strength, I suppose, then that suggests that a bounce is coming. So what's pretty crazy is in this case, if you look where my mouse is, on February 10th, we had the swing bottom or the swing low in the TIP ETF, and then we bounced. And then the bounce was right at the swing low. The top of the bounce is at the swing low of the S&P 500 in March. And so I think that that's really interesting. And so I'm wondering if now that I'm wondering if bonds are indicating here. So you see the S&P has bounced, but also bonds actually bounced on the 10th slightly. And so are we going to see bonds continue to fall and our equities going to follow them? And I'm not really sure, but I just thought that was something really interesting to look at. So let's take a quick look at, whoops, I'm on the wrong chart. Let's take a look at gold. Here we go. And gold has gotten actually above, let me darken this trend line. Gold has gotten back above this trend line. We kind of fell below it, tested it as resistance, and then broke back above it. And so as much as gold is really disappointing, it honestly wouldn't surprise me to see kind of a slow grind up this way. It's really hard to get a gauge, like what is gold trying to tell us? Because typically you would expect in this kind of situation that gold would be, going up, skyrocketing, and it's not. And so it makes me wonder if, gold is signaling something different than what we all think. I mean, I don't really know what that thing is. I'm still trying to really think through it. But that is something to be aware of. We'll take a look at oil here. I don't really know what else there is to say other than over here I again called that we would consolidate sideways and then slowly start to come up and away, and that is still happening. And just so you guys know, I mean, like I what's the worst that oil could do? I mean, if we get a pullback, which is entirely possible, I don't see us coming lower than 93.53. I don't think that oil will be lower unless we have a massive deflationary shock that affects oil and like destroys demand so much that oil comes down. Like I see no reason to ever to believe that oil will be under 93 for, I don't know, for years. I mean, maybe forever. I don't know. But the upside potential on this is insane. So I mean, not really a whole lot else to say there. And then Bitcoin. Bitcoin, everybody got really excited on the May 30th bounce, which was on Memorial Day, which was a market close day, and lower volume and all of that. And we're back down just above that level where that green candle started. So we've almost given all of that back. The one thing I would point out on Bitcoin, I've brought this up before, and a lot of people have on Twitter. I'm not going to take credit for this. Is that every time Bitcoin has been in a bear market, as soon as it crossed through, I mean, if it broke the 100-week moving average, then it would eventually have a date with the 200-week moving average. But that's also always where it bottomed, and that happened in 2018, and that happened in 2015 as well. And so that's as sad as that is. I mean, just given the macro backdrop now. Just understand Bitcoin can do Bitcoin things at any point in time. But just given the macro backdrop, given everything that's going on, I'm imagining that's part of the reason why I put this gold box right there, the top of those gold boxes. Because I think it's just a matter of time before I mean, it might just be a wick, but I think we're going to get there. I think we're going to get down to this level. That doesn't mean that you can't position, because honestly, like, just look at Bitcoin's history. Let's put it on a log chart. Like, look at Bitcoin's history, and tell me, in 4 years, do you think that we're going to be higher or lower than we're currently at? And I think that that's definitely something to consider. So I wouldn't say that it's wrong. I mean, if you're buying Bitcoin and holding it forever, or holding it for a period of at least a few years, I see nothing wrong with buying here. But if you're looking for quick, making a quick buck, looking for quick price moves, then you got to be careful, because if you're buying thinking, oh, it's going to move 10% or 20%, and then I'll sell it really quickly and make a quick profit. I mean, you could buy, like, how many people bought near the top of this candle thinking now's the time, and now they're already underwater. And then, of course, market psychology comes in. So I'm looking for price to at least wick down to this box. The second box down there, by the way, is where the old all-time high is. It's kind of a general area, the 2017 peak. And I don't think we're going to get there, but it's possible. I mean, anything's possible, just given the macro backdrop. But that's kind of where I'm at on that. Now, I do want to briefly take a look at the SAMS indicator for the markets. And again, this gives you an idea of the general strength and momentum, and the statistical likelihood that price is going to move a certain direction. You can see here on the equities, I used the 3-day. At least more recently, I've been using the 3-day. Bearish on the S&P, bearish on the NASDAQ, bearish on the Dow, bearish on the Russell if this will load. On the dollar, bullish. On yields, bullish. On Bitcoin, we're bearish. On gold, we're neutral, although on gold, I tend to look at the daily chart. And on the daily chart, we are bearish. And then on oil, we're bullish. And so that's kind of the look at the markets, and obviously sharing through the SAMS indicator. I hope that this market wrap was helpful. Don't forget to hit the like button and to subscribe if you have not yet, and to share this with somebody who you think might find it beneficial. Definitely got to be careful out there. Be cautious about your downside. I guess in short, and again, I'm not a financial advisor, but what I would say is on any existing positions, you need to either get. I don't even know if I should say this, but if it were me, what I would do here and what I have been doing is hedging positions that I am unwilling to get rid of completely, and any capital that is at work in more speculative positions if it's not to the downside, if I'm not taking the position to the downside, then I am out. Again, hedge what you want to keep against your downside risk, and then get out of the things that you are not high conviction in. And that's kind of what I'm doing. So I hope you guys have a great day, a great weekend, and stay safe out there, and I'll see you guys next week.